What if I told you that generating $3,000 in monthly dividends is more achievable than most people realize? Many investors mistakenly believe that they need a massive nest egg to retire comfortably, dramatically overestimating what's actually required. Using the SCHD retirement calculator, I've uncovered 3 distinct pathways to reach that $3,000 monthly dividend target, like building a money tree that grows more productive over time. In the next few minutes, I'll break down exactly how much you need to invest based on your specific timeline. Whether you're searching for immediate income or planning decades ahead, these dividend strategies could transform your retirement outlook completely. Did you know that most Americans believe they need over $1.5 million to retire comfortably? This staggering number sends waves of anxiety through the financial planning community and leaves many everyday investors feeling like retirement is an impossible dream. But what if I told you that this widely accepted benchmark might be unnecessarily inflated? This is what I call the retirement reality gap, the significant disconnect between what people think they need for retirement and what they actually need to generate sufficient income. Traditional financial advisors have long pushed the idea that you need massive portfolio values to retire, typically suggesting save at least $1 to $2 million if you want to retire with dignity. This perspective makes retirement feel completely unattainable for the average person who's struggling with monthly bills, housing costs, and everyday expenses, creating a sense of financial hopelessness. The root of this misconception comes from focusing on the wrong metric. For decades, financial planning has emphasized total portfolio value rather than income generation potential. It's like judging a car solely by its size rather than its fuel efficiency and performance. When we fixate exclusively on accumulating a specific dollar amount, we miss the more important question: how much income can your investments generate to cover your actual monthly expenses? Let's look at the numbers. The average American approaching retirement age has saved approximately $134,000, while believing they need over 10 times that amount. This perceived shortfall creates unnecessary stress and often leads people to take on excessive risk or simply give up on retirement planning altogether. But what if the solution isn't necessarily saving more, but investing more strategically? This is where SCHD, the Schwab U.S. Dividend Equity ETF, enters the picture as a potential game changer. With approximately $69.2 billion in assets under management, it's a highly liquid investment option that offers a unique combination of current yield and dividend growth potential. Unlike traditional retirement calculations that assume static investment returns, SCHD's dividend growth characteristics fundamentally alter the retirement equation. SCHD currently offers a 3.5% yield with a remarkable 12.2% dividend growth rate historically. This means your income stream from SCHD doesn't remain static. It actually grows substantially over time. Its rock-bottom expense ratio of just 0.06% ensures that more of your money stays invested rather than going to management fees. In practical terms, traditional retirement calculators might suggest you need well over $1 million to generate $3,000 monthly in retirement income, using typical withdrawal strategies. But with SCHD's yield and growth characteristics, the actual amount needed can be dramatically less, especially with time on your side. When you factor in SCHD's historical dividend growth rate, the initial investment needed to eventually generate $3,000 monthly in dividends shrinks significantly with each year of your investment horizon. For someone looking to retire in 20 years, the initial investment needed could be just a fraction of what conventional wisdom suggests. This approach transforms retirement planning from an exercise in deprivation, save more, spend less, to one of strategic positioning. Instead of fixating on accumulating a massive portfolio, you can focus on building an income-generating engine that grows more powerful year after year. Building an income-generating engine sounds promising, but have you ever wondered why SCHD specifically outperforms most other dividend ETFs? The answer isn't hiding in its current yield alone, but rather in its fundamental approach to selecting investments. While many investors chase the highest immediate payouts, SCHD's philosophy centers on something far more valuable for long-term wealth creation: quality over quantity. Look beneath the surface and you'll find SCHD's portfolio packed with companies that prioritize financial strength and dividend reliability. Its top holdings read like a who's who of the blue-chip stalwarts: AbbVie at 4.7%, Coca-Cola at 4.6%, and Amgen at 4.5%. These aren't just random picks. They're companies with proven track records of maintaining strong balance sheets and generating consistent profits quarter after quarter. This commitment to quality creates a rock-solid foundation that supports both current income and, more importantly, future dividend growth. SCHD strategically spreads investments across different economic sectors, with 17.7% allocated to financials, 17.6% to healthcare, and 14.8% to consumer staples, among others. This diversification creates natural protection against sector-specific downturns. When healthcare faces challenges, financial stocks might be thriving, helping maintain the fund's overall stability and income generation. These quality companies with their strong fundamentals are precisely why SCHD has delivered impressive results. The fund has generated a 13.3% return over the past year, approximately 12.5% annually over 5 years, and 11.6% annually over the past decade. These figures represent total returns, combining both share price appreciation and dividend payments that fuel retirement income. For retirement planners, SCHD's dividend growth rate dramatically changes the retirement math in your favor. The current 3.5% yield provides immediate income, but it's the impressive growth trajectory, 12.2% over the past year, 9 to 10% annually over 3 years, and 12 to 13% annually over 5 years, that creates a powerful compounding effect. Let me show you how this works. Imagine investing $10,000 in SCHD today. At the current 3.5% yield, you'd receive about $350 in dividends the first year. Not life-changing money. But fast forward 20 years, assuming historical growth rates continue and you reinvest all dividends, that same initial investment could be generating approximately $2,800 in annual dividends. That's an effective yield of 28% on your original investment, transforming a modest initial yield into a significant income source. When compared to broader market alternatives like SPY, which tracks the S&P 500, SCHD offers distinct advantages for income-focused investors. Not only does SCHD provide a considerably higher current yield, 3.5% versus SPY's 1.5 to 1.7%, but it also experiences less dramatic price swings with its beta of approximately 0.88. This reduced volatility becomes particularly valuable during retirement, when you're actually living off your investments and can't afford the emotional and financial stress of extreme market fluctuations. This stability advantage addresses one of retirement's biggest hidden dangers: sequence of returns risk. When you're drawing income from your investments, a severe market downturn early in retirement can permanently damage your portfolio's long-term income potential. SCHD's lower volatility profile helps mitigate this risk, providing more reliable income precisely when you need it most. The 3 time frame strategy: immediate, medium, and long-term income plans. That remarkable stability we just discussed becomes even more powerful when you consider how your investment timeline transforms the entire equation. What if I told you that reaching your dividend income goals requires dramatically less money than most people assume? The timing of when you need that income creates a stunning difference in how much you need to invest today, a difference that could completely change your retirement strategy. Picture this: $1 million mountain versus a modest $200,000 hill. Both can lead to the same destination, but one path requires a fraction of the resources, all because of the transformative power of time. Let's examine 3 distinct time frames for reaching that $3,000 monthly dividend goal with SCHD. Immediate income plan. For those already retired or planning to retire within a year, you'd need approximately $1,028,571 invested in SCHD to generate $3,000 monthly, $36,000 annually at the current yield. This substantial sum creates the perception that dividend investing belongs exclusively to the wealthy, discouraging many potential investors before they even start. 10-year horizon plan. The numbers shift dramatically when we extend our timeline. With a decade to work with, perfect for those in their 50s or planning early retirement, you'd need approximately $500,000 initially invested. This generates $4,550 in monthly income after 10 years, $54,600 annually. That's significantly more than our target, powered by SCHD's consistent dividend growth compounding over time. 20-year strategy plan. Here's where the picture transforms completely. With a 20-year approach, ideal for investors in their 30s or 40s, an initial investment of just $200,000 could generate approximately $6,300 monthly, $75,500 annually. That's over double our $3,000 target, all from the extraordinary power of compound dividend growth across 2 decades. Take a moment to absorb this. The 20-year plan requires just 19% of the capital needed for immediate income. This revelation transforms retirement from a distant, anxiety-inducing goal into something tangible and achievable within a normal working career. It challenges conventional wisdom that building wealth requires either exceptional income or extreme frugality. The dramatic difference across timelines dismantles the myth that dividend investing works only for the wealthy. The real power lies in giving your investments enough time to compound and grow, not in having massive capital today. For younger investors especially, understanding this time horizon effect creates financial liberation. You don't need a 7-figure portfolio in your 30s or 40s when you leverage dividend growth strategies effectively. Instead, modest but consistent investments coupled with reinvestment and patience build your income-generating engine over time. Think of it this way: each year you add to your investment horizon essentially provides a discount on how much you need to invest today. This perspective makes retirement planning far more accessible to average earners. Of course, these projections assume consistent dividend growth from SCHD, which, while supported by historical performance, isn't guaranteed. However, even with more conservative growth estimates, the principle remains steadfast. Time dramatically reduces the initial investment required, making dividend investing a viable strategy for investors at virtually any financial stage. The dollar-cost averaging approach, building your $3,000 income stream month by month. While large lump sum investments can certainly accelerate your dividend journey, they're simply not realistic for most Americans. What's rarely discussed is how ordinary income earners can transform modest monthly contributions into significant wealth. Would you believe that investing just $1,000 monthly, about what you spend on car payments and insurance combined, could eventually generate nearly $8,000 in monthly passive income? Meet Sarah, a teacher who started investing $1,000 monthly at age 35. She didn't have a financial windfall or inheritance, just determination and consistency. Sarah embraced dollar-cost averaging, a practical investment strategy where you consistently invest a fixed amount at regular intervals, regardless of market conditions. This approach works perfectly for those who don't have hundreds of thousands of dollars sitting around but can carve out a portion of monthly income for investing. Building wealth on an average salary requires discipline, especially when balancing mortgage payments, raising kids, or paying off student loans. The dollar cost averaging strategy accommodates these real-life constraints, focusing on consistent action rather than requiring extraordinary income. When you commit to investing $1,000 monthly into SCHD and reinvest all dividends, remarkable transformation occurs. By the 10-year mark, you'll have contributed $120,000, but your portfolio could grow to approximately $190,000. You'd be generating about $610 in monthly dividend income, a meaningful supplement representing nearly 2/3 of your monthly contribution. As you cross into your second decade, the power of reinvestment accelerates dramatically. Your portfolio benefits not just from your contributions, but from the snowballing effect of dividends generating more dividends. After 20 years, your $240,000 in contributions could potentially grow to around $632,000, generating approximately $2,470 monthly, enough to cover many households' basic expenses. For those with a 30-year horizon, typical for someone starting in their 30s like Sarah, the compounding effect becomes truly life-changing. With $360,000 in total contributions over 3 decades, your portfolio could reach approximately $1,860,000, yielding around $7,750 in monthly dividend income. That's nearly 8 times your monthly investment amount, creating true financial independence. What makes dollar cost averaging particularly powerful is how it transforms market volatility into an advantage. When share prices drop, it's essentially a clearance sale on your future wealth. Your fixed monthly amount automatically buys more shares. When prices rise, you benefit from appreciation of your existing holdings. This mechanism prevents emotional decision-making and eliminates the stress of trying to time the market. The psychological benefit is profound. Rather than feeling overwhelmed by the need for a massive upfront investment, you focus on the manageable task of setting aside $1,000 each month. This creates momentum as you watch your dividend income steadily grow, reinforcing your commitment. The math shows that with consistent investments, you'd reach $3,000 monthly dividend income around year 25 to 26, completely achievable within a normal working career. Financial independence through dividends becomes accessible to everyday earners who understand the power of consistency. This approach aligns perfectly with how most people actually earn and save money, through regular paychecks. It transforms the intimidating mountain of retirement savings into a series of manageable steps, each building on the last. Dividend growth investing isn't just a method, it's a mindset that turns time into your most powerful asset. The financial industry has conditioned us to believe we need massive nest eggs, but time dramatically changes what's possible. Starting early means investing far less overall to reach your financial goals. Consider this: with a 20-year horizon, $100,000 invested could generate over $3,000 in monthly income. This makes financial independence accessible to average investors, not just the wealthy. Your path to substantial monthly dividends varies based on your timeline, whether starting with a lump sum or building through consistent contributions. Each year you begin sooner means thousands less invested overall. Even small, consistent investments in dividend growth stocks or ETFs like SCHD compound dramatically over time. Like planting a seed that grows into a money tree, your initial investment cultivates financial freedom. Start now and let compounding dividends redefine your future.